Well, welcome to everyone that's tuning into the recording, be it morning, afternoon, or evening. There's certainly been a substantial increase in both investor and developer interest toward the SDA sector from both private and institutional capital over the past 18 to 24 months. But as a sector that's still very much in its infancy, there does remain a lot more questions than answers. Bruce, Tony, and CBRE have decided to put this very brief video together to cover a number of the most talked about or common questions that we receive in relation to development and projects in the SDA space. And while we could well talk for hours on the topic, the purpose is certainly just to be a brief but informative overview for everyone, and specific questions can then of course be directed to Tony or Bruce, and their contact information will certainly be made available following the recording. In terms of some brief background on the two speakers, Bruce Bromley is one of three co-authors that developed the NDIS Specialist Disability Accommodation Design Standards and is an accredited SDA assessor. Bruce has over 35 years experience in disability access, architecture, documentation, and project management, and is well placed to consult for developers, property managers, and investors. Tony Rutherford is a partner at leading national law firm Holding Redlich, specialising in construction, infrastructure and projects, advising on large and complex transactions and disputes. Tony's been involved in a number of significant appointments and is also a key contractor on the Victorian Public Housing Renewal Program. In addition, Tony regularly advises developers and disability service providers on the regulatory issues surrounding the NDIS scheme. Now, question one, Bruce and Tony, thank you for taking the time to join us and provide some information to everyone that will be watching the recording. Bruce, we'll start with you, but how have you seen interest in activity within the SDA landscape change over the past few years particularly?
Sure. Prior to October 2019, which is when the new SDA design standards launched, there was no certainty for developers in terms of getting projects registered, certified. When the new design standards came in, we had a whole new process. So it means that once projects get to a construction design stage, they can receive a provisional certification, which now gives developers some assurance that once the project has been delivered, and it has been delivered in accordance with the accredited drawings, they will get the property registered, which previously wasn't the case. So it has provided a lot more surety and also has made the lending process a lot easier. Again, prior to 2019, it was very hard for investors and developers to actually get funding for SDA due to the increased construction costs over conventional dwellings.
Tony, do you have anything to add to question one in terms of what you've seen? You've probably been engaged by a fair few people, and increasingly over the past year or two, I'd guess.
Yeah, I mean, if you look at the way that the SDA market's developed, certainly in the first few years, there were key players within that market that were at the forefront of the development of SDA dwellings, and there was still a decent amount of uncertainty at that point. And then in 2016, there was an investor brief that came out from the NDIA, which created more angst within the sector rather than creating a greater sense of certainty. And then so it was that kind of first wave of the initial players in the market, and then following that 2016 investor brief, there was really a bit of a pause, I think, in terms of the way the market was developing. And then there was, following probably a few things, including what Bruce described in relation to the design standards, but a bunch of other factors as well. Certainly, it's increased a lot, over the last 18 months, and I think it's probably for a few reasons. One, because of those first movers in the market and tested out the market and kind of worked out how these things were going to be structured, what the key risks were, and there were some kind of key learnings that other developers were able to pick up on. I think lenders, particularly in this space, have had to get across key risks associated with these projects as well. So I think there's been a period where lenders have actually had to get up to speed as well in relation to the risks they'll be looking for when they're lending on these projects. And I think on top of that, there's been increased certainty. There've been amendments to the SDA rules and other regulatory changes that have facilitated a focus on the sector as well. So I think there are probably a whole bunch of factors, and certainly we found at the point that COVID-19 came into play, I think there was increased interest in the market initially because of the nature of the government, for want of a better term, government-backed payments that are attached to each of the tenants. So certainly it's been very active over the last 12 to 18 months.
What is demand like from operators to lease SDA accommodation, and how have you seen the number of operators evolve over the past few years in that space?
Sure. So I see there's three areas of demand currently. So the first area of demand is people looking for SDA. So these could be people with aging parents and a reduced support network around them. So based on the current figures of the second quarter of this year, there's 3,461 people looking for supported accommodation. The second level is young people in aged care facilities. So as of 30th of June 2020, there were 4,860 young people living in nursing homes. So if you could imagine, that would be quite a dehumanizing process for them living in that sort of environment. You're young and you might just have a physical disability, but you're stuck in an environment with elderly people. This is something that the feds have recognised and are prioritising that over the next 2 years to get those people out of nursing homes. The third area, which I think isn't being recognised fully, is particularly around the not-for-profit sector. So not-for-profits for many years have provided supported accommodation for people with disabilities. And whilst they have properties registered now as legacy stock under the NDIA, a lot of these properties are very old. We've been doing some feasibility studies with a number of not-for-profits, and some of the properties are 30, 40, 50 years old. So they're very old, very dated. And the issue that these not-for-profits have now is, if they don't start modernising and start bringing on properties that are more appealing to the people in their care, those people are going to be looking at moving into new dwellings with other providers and the like. So there's the issue of, what do they do? Do they do knockdown rebuilds? Do they just sell the asset off? Or do they come into partnership with a developer to redevelop their existing facilities? On the case of, if they sell off the assets, do they come to arrangements with SDA providers providing dwellings and have long-term lease arrangements with those organisations? And the providers then just provide the SIL services. So you'll see SIL referenced quite a bit. That means supported independent living. And that's the second stream of money that's provided to the providers to provide the day-to-day care for the participants. So cleaning, washing, meals, laundry, activities and the like. So to understand, there's two streams of money, one stream to provide the building, one stream to provide the services. And I can see the not-for-profit sector and even some of the for-profit sectors that have a lot of assets that are getting old and dated are going to have to really address how they're going to modernise their portfolios. So I think, if anything, that's going to be bigger than the first two put together.
Perfect. And Tony, do you have any further to add? No doubt there's probably been plenty of leases you've had to review over the past few years as well.
Yeah, I mean, I would agree with what Bruce has just said. I think what's going to be really interesting are the opportunities that exist in terms of partnerships between some of the, what I would call legacy, disability service providers that have a lot of these older assets, and they're trying to figure out what to do with those assets, and the capacity of developers and SDA providers to come in and partner with these organisations to potentially work out how they can work together to refresh those assets. So, and I've certainly been working with some of those legacy or more established disability service providers in terms of how they manage those existing assets. So certainly, you know, that's a real opportunity. And the more sophisticated service providers are looking at how they can manage those assets, you know, most efficiently. And they'll usually be focused on ensuring that they get the best outcome, obviously, for the participants that they'll be caring for. So in terms of, you know, if you're talking about an operator from an SDA provider perspective, you're just going to say, okay, you're going to bring in essence, a property manager. In the past, a lot of the, you know, developers have also become registered SDA providers. I think the more sophisticated lenders and investors will be looking for an SDA provider or a property manager that's got a decent amount of experience in the space to ensure that there's, you know, limited vacancy risk and other factors that will come into play. So I think you'll see a bifurcation over time where you'll have, excuse me, specialist SDA providers that are essentially property managers, and they'd be, you know, those are the ones that are most experienced kind of managing tenants with, you know, with special needs. And then you'll obviously have the owner entity, which really just wants to grow an income stream from these projects, and they're not at all well placed to necessarily be interfacing with the tenants. Yeah, that's kind of my view in a nutshell.
Perfect. Now, the next two, Bruce, we'll direct to you from a property perspective, and then we'll pick back up with a couple for you, Tony. But the third question, Bruce, what are the key factors for a developer to review when they're identifying a suitable location to produce an SDA product?
I put it back on the developer a lot, and I'll ask them the question, where do you want to live? And really, once you put yourself in the position of the person with disability, with an understanding that you don't drive, you know, where do you want to live? So the recommendations we have: close to retail, close to community facilities like libraries, community centres, close to public transport infrastructure, close to medical facilities. If it's a suburb, something that's relatively flat, not hilly, especially if they want to go out for the day or go up to the shops and the like, just to have that flexibility and the assets where they can be inclusive and included as part of the community. So to me, it's really focused around what anyone else would want in terms of where to live.
And the key factors that would differentiate an SDA accommodation or an SDA development from a regular housing or apartment complex, what are those? Because we often hear a lot of groups that we speak to think they're very minimal, whereas others that have done a lot understand that they're probably not so minimal at the end of the day as well.
Sure. So SDA's got 4 categories. We've got the lowest level is improved livability. And to be honest, it's not a lot different to a conventional dwelling. It has a little bit of extra space in it, toilet areas, extra reinforcement to some walls, again, for grab rails and the like. But essentially, spatially, there's not a lot of difference. The fully accessible and high physical support categories are designed for wheelchair accessibility. Size-wise, they're exactly the same, but we do have increased door sizes. We have fully wheelchair accessible bathrooms, bigger bedrooms again, so we've got circulation space around those beds for wheelchairs. So they are a bigger space, but proportionately the allowance within the price guide is significantly higher for those 2 types of dwellings. The key difference between fully accessible and high physical support, as I said, spatially it's the same, but high physical support has some additional provisions. It has things like UPS, so uninterruptible power supply to maintain life safety equipment for a 2-hour period. So that has to be provisioned, home automation, possibility of door controls. So what we often recommend to clients is, if they're not going down the high physical support approach, still design it to the high physical support requirements for fully accessible, and pre-wire and have it ready to go, that if they have a participant that wants to move in that is under the high FIS category, it's just a minor refit of adding the extra assistance equipment for them to move in. The last area is robust, and this is probably the most difficult one to deliver. Can't be in apartment buildings, really needs to be standalone dwellings or at least a townhouse type configuration. It has, as the name suggests, robust. It has to be robust because we're talking about people with behavioural issues that will damage properties very easy. So forget standard plasterboard, we're going into areas, impact check doesn't even stand up. So we're looking at yellow tongue wall linings with villa board, steel door frames, solid core doors. And the problem then is with the price guide is the returns for robust percentage-wise less than the other three categories. However, it's an area which I believe has got the highest demand at the moment. So it's a bit of a catch-22. If you build robust, you're pretty much guaranteed to have participants without any issues. The other three categories, again, there's still very high demand for them. The only other thing I would suggest is the pricing arrangements allow for up to 5 participants to live in a single dwelling. However, we're seeing demand really based around the 1 and 2 participants, the occasional 3. And again, it comes back to how would you want to live yourself? Do you want to share your home with 1 other person, 2 other people, 3 other people? And what we're finding is the single and dual share is the most popular for the participants because at least they can set their home up how they want and, you know, is their home at the end of the day.
Yeah, I might jump in there just in relation to that last point that Bruce raised, which is, I think that's right. I mean, I think most participants want to either be living by themselves or somebody, you know, that they know well. And you think about, like anybody in the community, you'd want to be able to, you know, either live independently in your own space or certainly live with people that you know well and you know you can live cohesively with. The tension between what participants want and what the NDIA want is that that when people are applying for SDA funding as part of their NDIS plan, there's a lot of pushback at the moment from the NDIA in relation to certainly living alone, and there are a number of appeals and challenges that are being run as part of the AAT process, Administrative Appeals Tribunal process, where people have not been given you know, funding to live independently, because obviously the numbers differ depending on whether you're living alone versus living with other people, and also differs depending on the nature of the dwelling, touching on the design requirements that Bruce talked about. So I think that also needs to be taken into account in relation to, I think most people have been building 1 and 2 bedroom kind of dwellings. I just thought I'd flag that as an issue that still really probably needs to be resolved as to how the NDIA is going to make these decisions going forward. The other point I'd make in relation to that is in this, I'm not sure they're going down the right path because in the context of the NDIA scheme, you know, if you look at the allocation of funding for SDA, I think it's around about $700 million a year or something in that range, in a scheme that's tens of billions of dollars, you know, whatever that's going to be, $30–40 billion. So consideration needs to be given, I think, from a design perspective as to not just the funding that applies to a person in relation to SDA funding, but then the cost of care and the cost of the supports on a day-to-day basis in relation to the people living within those dwellings. But I thought I'd mention that as a macro point, because at the end of the day, the funding follows the person, and then the funding decisions are in relation to each of those participants is really key in understanding certainly what the NDIA is doing in relation to those decisions.
Perfect. And that comment, Tony, on developments that you're seeing as well, that's very much in line with what we're seeing. It's all 1 and 2 bedroom style developments, be it a unit kind of complex or a townhouse style complex, that leases are being signed up for too by these pretty experienced developers in the space as well. Tony, one for you. In terms of legal documentation and requirements when a developer is signing up an agreement with an SDA provider or for an SDA project, what are the requirements? How do they vary from a standard kind of commercial lease? Do they vary at all?
Yeah, so I mean, the answer is yes, because of the nature of the nature of the accommodation and the services that are going to be provided there. And you need to ensure that, touching on the quality of the SDA provider before, that's really key. You need to ensure that certainly the owners of these dwellings want to make sure there's no reputational risk to them. So, you know, there are a whole bunch of requirements usually in those leases that will deal with that very kind of NDIS or SDA specific issues that as the owner of the property, you'll be concerned about, and making sure that there's no impact and that the tenants are properly catered to and that the property is properly managed. In terms of the overall structure of these projects, I mean, typically you'll have the SPV or whatever the ownership vehicle is going to be. It will typically be a unit trust of some sort, and then the question is, okay, what's the ultimate downstream structure going to be? Historically, that's always been head leases, and we'll get to the issue of head leases, I think, later on in this presentation. But there are reasons that, I mean, a head lease makes sense, and certainly based on legislation in certain states, for example, in Victoria, if you read the Victorian legislation, it essentially mandates that the SDA provider is either a head lessee or the owner of a property. So, so traditionally, head leases have been the main kind of document that the owners of the properties have entered into with the SDA providers. So, you know, then that's changed a little bit recently because of part of them are tax reasons. So we're also seeing essentially, instead of a head lease, there'll be a property management agreement or a housing management agreement that will be entered into with the SDA provider. And then obviously downstream from that, then the question is that there'll be an SDA form of residential lease entered into with the tenant. So that's either going to be by the head lessee if there's a head lease, or directly by the owner of the property if it's if there's no head lease and it's kind of a property management agreement. If you go with that second structure, there will still need to be some type of agreement between the SDA provider / property manager and the tenant, and that will usually take the form of an SDA services agreement, because there needs to be some arrangement there. So that's kind of the general structure. And then a couple of other things worth mentioning is what we're seeing is certainly through a lot of the investment funds that are entering into kind of long-term development arrangements with developers and SDA, well, primarily SDA providers. There will usually be a development management agreement between the fund and that SDA provider / developer, and they will usually get some kind of uplift, you know, 10% or so on the development costs. And then there will be usually a head lease or similar arrangement entered into at completion. The last thing to mention is there will also be a collaboration agreement between the SDA provider and the SIL provider. So there needs to be some kind of agreement, given that the employees of the SIL provider will be, you know, coming onto the premises, and there will usually be on-site overnight accommodation depending on the nature of the build. So you need to take into account the risks associated with other people being on site and how that's all going to be managed. So it's kind of an interface agreement between the SDA provider and the SIL provider about how that's going to be managed and how the risks and liabilities are going to be allocated between the parties.
Perfect. And you did just touch on it, so we'll go to that question now. But how have these contracts and leases evolved in the space, and has there been that shift toward the head lease or the performance linked arrangements between the providers and the developers?
Yeah, so I wouldn't say there's a at the moment. I mean, traditionally it's just been a head lease, and we're seeing that change for the reasons that I just mentioned, and I'll get into in a little bit. But traditionally it's been a head lease. In terms of how the risks are managed in terms of vacancy risk, that, we've seen head leases or commercial head leases where the vacancy risk can be borne by the owner, or it can be borne by the SDA provider slash head lessee or property manager, or that can be split. That's really coming down. That comes down to a commercial arrangement between the owner and the SDA provider about who's going to bear that vacancy risk. In some cases, the SDA provider or the owner will try to also push some of that vacancy risk onto the SIL provider. The argument for that is the SIL provider obviously generates income off these tenants and is usually the source of the tenants. I haven't seen a lot of SIL providers willing to take vacancy risk. It's usually some kind of allocation between the owner of the premises and the SDA provider. So that's really a commercial negotiation that needs to occur. For the more sophisticated funds, what we're seeing is they'll just enter into a fixed head lease. So they just want a guaranteed return. So the vacancy risk is, and that's kind of a shared risk is probably the best way to put it. So the SDA provider, under the terms of that head lease, for example, will guarantee monthly payment as you would with any lease. To the extent of any upside, they will get the upside. So if it's leased to a 100% level, then obviously the head lessee or the SDA provider will get the uplift because it's leased to 100%, whereas the payments required to meet, the vacancy levels, or rather the tenancy levels required to meet their payments under the head lease might be 70% or something like that. So usually a fixed head lease for those funds is the standard at the moment because they're just seeking an annuity guaranteed return and a low risk kind of return.
And that makes perfect sense. That's what we're seeing as well from funds and institutional groups looking to acquire these assets. Their preference is for that head lease. It makes the transaction a lot more straightforward as well. Now,
I think I'll just put one thing on that is we're seeing most SDA developments being factored on the high physical support category, which has obviously got the highest return. That part of the market's going to bottom out first, and we will get into a situation where there won't be enough participants to be able to move into those high physical support dwellings. So we've actually been suggesting to a lot of our clients to actually base their investment on fully accessible, then treat a high physical support participant as a bonus. And purely because we're just seeing it job after job after job, high physical support, whether there's some greed in there or not, who knows? But I think it is going to bottom out very quickly, maybe in 4 or 5 years. And then we're going to have a glut of all these high physical support accommodations where there aren't the participants to go into them. So that's just the only area of caution I think needs to be shown.
Yeah, I agree. And the NDIA has explicitly said that, the number of people that are going to be funded to high physical support levels is going to reduce significantly. So to reiterate what, or to echo what Bruce is saying, when you do your modelling, don't assume, you need to be realistic about, the levels of funding that the participants are going to have and how that's going to impact, your returns. And I wouldn't be expecting, excessive returns. They're going to have to be realistic in terms of the tenant mix.
Okay, perfect. We'll cap off with GST, Tony. It's there's some mixed opinions out there at the moment. I think there's still a bit of an unknown, but GST implications for developers constructing SDA projects. What are they? What are you seeing? Is there some certainty around those implications at the moment?
Yeah, I think there's still a bit of uncertainty at the moment. There have been some private rulings that have been sought by developers in relation to particular structures. The main issue lies in the context of a head lease, to be frank. The reason for that is under Section 3830, and just to be clear, I'm not going to be providing tax advice. I'm just going to give you an overview of what the issue is. So under the GST Act, the provision of SDA accommodation is a GST-free supply. early on there was an assumption, that would flow through, and there's that would flow through to the owner of the dwelling, and therefore they could claim back GST on construction costs. That's potentially still a possibility, but it really depends on the nature of the dwelling that you're building. So you need, and there's some, other contractual structures that are designed to get around this issue, or not get around, but still be compliant is a better way to put it. I think the key point would be go and get tax advice from an experienced advisor in this space, because it really it needs to be assessed on a case-by-case basis as to whether you're going to be able to claim back the GST on those construction costs. And I think touching on the point that I just raised in terms of the modelling and the kind of returns you're going to be expecting at those lower levels of design funding, if you think about improved livability, that 10% claim for GST on construction is, that makes a difference in terms of the viability, or may make a difference in terms of the viability of that project. So you need to go and get good tax advice, but it's still a little bit unclear in terms of where this is all going to fall. So you really do need to get good tax advice if you're expecting to be able to claim back GST. You need, in terms of structuring that project, you need to get good advice, tax advice, and legal advice.
Perfect. Well, we'll wrap up there. Bruce, Tony, thank you for making the time. For all those with a specific interest in the sector and learning a bit more as well, obviously you can contact Bruce and Tony directly, but you can also register for the Developing Specialist Disability Accommodation conferences. They're being held across Melbourne and Sydney in February, March of 2022. We'll have a link for the registration page at the wherever you're going to see this video. Bruce and Tony will both be speaking there, so that will be included for you to register your interest. So Bruce, Tony, thanks again, and no doubt there'll be plenty of people that will probably need to speak to you off the back of this.
Thank you.
Thank you.